Welcome to cost accounting class. In this particular video, I'm going to deal with the introduction to process costing. Process costing is a costing method that is usually used where production is done as a continuous process. So in many manufacturing companies like oil refinery companies and other manufacturing companies, one of the costing methods that they can adopt for their production is process costing. Because with production done as a continuous process, it's difficult to actually find or identify an individual cost unit. So process costing method becomes one of the best costing methods that can be used. Now, under process costing, you will be required to open process accounts. Process accounts are simply simple control accounts that have debits and credits. So a process account with debit and credit, I'll be able to show you how the process account is done with the debits and credits. But basically with the debits, you are looking at recording whatever inputs that goes into the process that includes the material that you have used in that particular process, plus the conversion costs that you have incurred in the process of converting the raw materials to finished goods. And on the credit side, you're looking at the outputs from the process. Outputs from the process, which we include, of course, finished goods produced from the process, work in progress if you've got work in progress, normal losses that you have incurred during the process and everything like that. So basically a process account will have the debits and the credits, and what you record on the debit side are inputs into the process, and what you record on the credit side are outputs from the process. Video, I just want us to explain the terminologies that I use, the concepts that are there, and then to also show you a format for process costing account, So you must be on the lookout for the video number 2 that I'm going to do on process costing, which of course will deal with a big question that we are going to do in process costing. But before we go to that particular big question in that next video, we need to understand the basics of process costing, the basics of process costing. So in process costing, first of all, you have issues of materials. These are materials that have been issued from stores and they have been given to the production department, and the production department is there to convert these raw materials into finished goods. So you have material inputs into the process. You need to assess how much material has been input into the process and at what cost. So here you'll be given things like let's say, for the sake of the example, let's say you have 1,000 kg of materials input into the process. 1,000 kg of materials input into the process, and let's say at the cost of maybe 20 kwacha per kg of material, 20 kwacha per kg. So you have 1,000 kg of materials input in the process at 20 kwacha per kg. Obviously, the cost of these materials input into the process will be 1,000 kg times 20 kwacha per kg. This will be something like 20,000 kwacha worth of materials input into the process. 20,000 worth of materials input into the process. Now, number 2, you need to understand the conversion cost. This is supposed to be conversion, the conversion costs. What are conversion costs? Conversion costs, these are costs incurred in the process of converting raw materials to finished goods. So what costs are you incurring in the process of converting raw materials into finished goods? So you have conversion costs such as labor. Maybe you are incurring costs of labor, direct labor. Let's say the labor cost was, for the purpose of the example, let's say the labor cost was 19,000 kwacha. 19,000 kwacha incurred in terms of labor cost. Normal loss. Normal loss, this is the expected loss from the process. No process is 100% efficient or 100% perfect. Every time you're doing a production process, there will be losses such as spillages, wastages, items breaking, and things like that. So that will result into losses. Now, there is a loss that is acceptable. Organization can accept from a given process. So the acceptable loss is what we call normal loss. So normal loss is simply acceptable or expected loss. Normal loss, acceptable or expected loss. This obviously is determined from past experience. Organizations can know from their past experience that every time they are running a process of that kind, these amounts of materials will be lost in the process due to things like spillages and wastages. So let's say for the purpose of the example we are dealing with, let's say normal loss is say 10% of the materials input. So let's say normal loss is at 10%. Now, abnormal loss, this happens when actual loss exceeds normal loss. If you have actual loss that is higher than normal loss, then you have the issue of abnormal loss arising. So for example, 10% normal loss from the inputs. We have 1,000 kg of inputs. Normal loss 10%, it means that normal loss is going to be 100 kg. 10% of the input materials, 100 kg, will be normal loss. Now, if we have actual loss that exceeds 100 kg, then we should say we have an abnormal loss. On the other hand, we can have an abnormal gain if the actual loss is less than the expected loss. So it depends with what you have. The actual loss is less than the expected loss, then you have an abnormal gain. Actual loss higher than the expected. Calculating the cost per unit, there are two models you can use to calculate the cost per unit. I'll be able to show you those two models in the two examples that I'll give you in our next videos. Cost per unit, if you have work in progress, then you have to use the equivalent unit kind of model to calculate the cost per unit. So in the presence of work in progress, so let's do that. In the presence of work, use equivalent units model. Equivalent units to calculate the cost per unit. You're going to use the equivalent units to calculate the cost per unit. So what are equivalent units? These are units that could have been produced according to the work in progress units you have and the degree of completion. For example, if we have work in progress, say 300 units or 300 kg in this example. We have work in progress 300 kg and levels of completion will be given. So if you are given degree of completion, say in terms of materials, maybe you are told that in terms of materials, the work in progress is 100% complete in relation to materials. So the equivalent units for materials will be 300 kg. In relation to labor, you might be told that degree of completion in terms of labor, let's say it's 50%. If you are told that in terms of overheads, which is another part of conversion cost. So in terms of overheads, maybe you are told that in terms of overheads, this is about 20% complete. 20% complete equivalent units will be equals to 20% of 300, which will be, of course, a 60 kg. 60 kg. 20% of 360 kg. So to calculate the equivalent units, it will depend with the degree of completion in terms of the costs, degree of completion in terms of the cost. And material is always 100% complete in terms of work in progress, but labor and overheads, which are conversion costs, at the end of the period, those costs might not be complete on the incomplete units. So work in progress simply means units that you started working on, and those units are not yet completed at the end of the period. Now, where all units are completed, how do we calculate the cost per unit? The cost per unit, if you do not have work in progress, the cost per unit will be, where there is no work in progress at the end of the period, the cost process, then you simply subtract value of normal loss, subtract value of normal loss, and everything divided by expected good output, divided by expected good output. Now, the expected good output is simply the input units minus normal loss units. Input units minus normal loss. This is the expected loss. So if you are expecting 10%, for instance, you are expecting 10% of the materials to be lost during the process, then your expected good output would be the materials you started with 1000 kg minus 10% of 1000 kg, which is going to be 900 kg. So the expected good output will be 900 kg. So the cost per unit, if you do not have work in progress, you simply say total minus scrap value of normal loss divided by the expected good output. That's the formula for calculating the cost per unit. So now let's define what work in progress is. Work in progress simply means you started working on these units of materials, and at the end of the period, the process is not complete. So you don't have the completed units. You have units you are still working on. So that is called work in progress. Then finished goods, these are stores for sale because the units are completed. But with the work in progress, you may transfer work in progress to the next stage in the process, because the process of manufacturing goods may be in stages. So from process 1, you go to process 2, you go to process 3, and things like that. So the work in progress from process 1 may be required to go into another process, and in that process it will become the opening work in progress. Closing work in progress in one process becomes the opening work in progress in another process. So now let's just come to the part where we look at how the process account looks like, Now this is the T account. This is the T account with the left side of the T account, we are dealing with the debits. Right side of the T account, we are dealing with the credits. So let's say debit side of the T account, that's the side we're talking about. And on the other side, we are dealing with the credit side. All right, so debit, credit. details. So what we put on the debit side of the materials input into the process, you need to record the kgs of materials or the units of materials and record the value of those materials. Then you come to conversion cost. Conversion cost, these are just cost of converting raw materials into finished goods. And among the conversion costs, you have labor. We don't have units for labor, so just record the cost of labor. Then you'd come production overheads, record the cost for production overheads. Now, I said two things might arise when you're dealing with losses. Two things might arise when you're dealing with losses, the differences between actual output and the units you started with. First of all, we say there is normal loss, which is the expected loss. That expected loss will be recorded on the credit side of the process account. Secondly, we have an abnormal loss, which is the excess loss over the expected loss side of the process account as well. But where abnormal gain arises because the actual loss is less than the expected loss. So in other words, the organization has got a gain on it. So that abnormal gain is going to be recorded on the debit side. Abnormal gain on the debit side. So abnormal gain, you will record how many units of abnormal gain and what's the value of abnormal gain. You take the total number of units recorded and the total value for those units. Then on the credit side of the process account, you have things like good units produced, which we can say good output from the process. Record how many units of good output and what's the value of good output. Now, just to coin in something, the value of good output, good units, is what you are going to calculate using the formula that I gave you: total cost of the inputs minus the scrap value of normal loss divided by the expected good output. That expected good output is simply input units, in that case 1000 kg, minus normal loss units 100, which would be of course 900 kg as expected good output. The reason why we work it out like that is because abnormal loss and abnormal gain units will be valued at the same value as the good units. So the only units that are valued differently for the purpose of the process account is normal loss. Normal loss will be valued at scrap value, but abnormal gain, abnormal loss will be valued at the same value with the good units. Then you will have, as the second item, you will have normal loss. Normal loss on the credit side, record the units for normal loss and the value of normal loss. Now, normal loss units will be valued at scrap value. The other thing that can happen in this account is where you have an abnormal loss. Abnormal loss. This is the excess loss over the normal loss. Excess of the loss over the normal loss. So you record how many units of excess loss and what's the value of that excess loss. Then you have other things that may happen. If you have work in progress comes on the credit side. Work in progress, and you have to record how many units of work in progress, and the value of work in progress. But always remember that work in progress units, you need to calculate the value using the equivalent units. Calculate the value of work in progress using the equivalent units model. You'll be given the percentage of completion and calculate the equivalent units so that you can calculate the cost per equivalent unit. I'll be able to show you that in the second video when we deal with the example. There is a big question that I'll be doing in the next video, so please be able to watch out for that video. Big question that I'll be dealing with. So let me just create a bit of space there. The other thing that can happen on the credit side of your process account is if you have a byproduct is a product that is produced as a consequence of producing another product. Maybe you are producing a particular product and eventually you have byproducts coming out. So byproduct treatment of the byproduct will be the same as the treatment for normal loss. So if you have a byproduct arising, treat it in the same way as you are treating normal loss. So that will also add scrap value. So it's the units of the byproduct that you have and the value of that byproduct that you have. What you need to have at the end of the day is that your debit side and the credit side must be equal in terms of the number of units and the value, in terms of the number of units and the value. So that's how the process account look like. That's how the process account look like. Now, just to clarify, you cannot have abnormal gain arise at the same time with the abnormal loss. These two are mutual. They are alternatives. If you have abnormal loss, you can't have abnormal gain. And if you have abnormal gain, you can't have abnormal loss. So in this process account format, I'm just showing you same time or in the same account. So in summary, what we've done here, we've looked at the format for the process account. Debit side of the process account, we record all inputs and the costs into the process. Credit side of the process account, we record outputs from the process, which may be in form of good units produced, normal loss or abnormal loss that arises, or work in progress that is transferred to another process, or the byproduct that is arising from the process. So when you come to do the individual accounts for abnormal loss and abnormal gain, for example, you're doing abnormal gain account. Abnormal gain account, here it's debited, you know the double entry. When you debit here in the actual abnormal gain account, you are going to credit. So when you credit the abnormal gain account, you need to adjust it for the scrap value of the abnormal gain units before you transfer the figure to profit and loss. The abnormal loss account will be debited because if it's credited in the process account, it will be debited in the abnormal loss account, and again adjust it for scrap value of abnormal loss before you transfer to profit and loss account. So in summary, this is just the introduction to process costing. In my next video, I'm going to deal with a very big question on process costing that has got all the elements that we have discussed in this video. Thank you so much for your time. Look out for the next video.